Hello friends, welcome back to my channel Sia Amit Parekh. Today we will be discussing the various options available to individuals for tax planning for FY 21-22. Some of the options are based on expenses done by the individual and other options are based on investments to be made by individuals. So let us get started. First, let us see the topics which we will be covering today. There are some investment-based deductions, that is section 80C, 80CCD, which will see what type of investments are allowed. And there are some payment-based deductions, again section 80C, 80D, and 80E. Payment-based deductions means we get the deductions based on expenses which we incur. And there are some income-based deductions. There are only two, 80TTA and 80TB. These are given on the basis of some income which we earn. Mostly it is interest income. Let's see. First we'll see section 80C. In this, a maximum deduction of 1,50,000 is allowed per year. And this section covers both investment-based deductions as well as payment-based deductions. So in investment-based deductions, first is ALSS funds. This means equity-linked saving schemes. These are the mutual funds which are linked to equity. And when we invest in these mutual funds, we get deduction. But there is a lock-in period of 3 years. Minimum 3 years lock-in period is there. It can extend to maximum 5 years of lock-in period. So if we remove the investment, if we liquidate the investment before 3 years, then the tax benefit which we get will be reversed by the income tax department. But there is a very good return in comparison to other investment-based deductions because it is market-linked and it is based on equity shares. Second comes tax saving fixed deposits. In this, the assessee has to make investment in bank fixed deposits for a minimum period of 5 years. There is a good interest rate also offered because the period of investment is 5 years. And on this also, there is ATC benefit is given, maximum 1,50,000. Next comes Public Provident Fund. Public Provident Fund are the provident fund scheme set up by the Government of India. In this, there is a very good interest rate given and cumulative interest is given to the assessee as well as deduction is given in the year of investment of 1,50,000. Also, one more good thing about this scheme is that the interest which is received on the PPF deposits is cumulative and the interest is also tax free whenever it is received. So, and this is the safest scheme. There is no risk involved in relation to market. So it is very good scheme to invest. And there is a lock-in period of 15 years in public provident fund schemes. After 15 years, we get both our investment as well as the interest accrued on it back. Then the next is employee provident fund scheme. Actually, some of the big companies have they are obliged to open recognized provident fund for all the employees, and they contribute a certain percentage of the employee's salary into the provident fund. So whenever the employer deducts provident fund from the salary and deposits into the provident fund account, the employee gets a deduction under ATC. Then comes unit linked insurance plan. This is also a very good instrument for tax saving, and this, as the name suggests, there is the amount which is paid by the assessee goes a part of it goes towards the market investment, and the part of it is covered is goes to the part of it goes towards insurance. So there is insurance as well as investment done in these ULIP schemes. Then comes national savings certificates of the Government of India. There is interest given on these certificates, but this interest is taxable. Unlike PPF, the interest on national savings certificates is taxable, but this is also eligible for ATC investment deduction. And last one is Sukanya Samruddhi schemes. This is specifically incorporated by the Government of India for the benefit of the girl child. Under this Sukanya Samruddhi scheme, the investment has to start before the girl child turns 10 years, and this scheme can go on for for 21 years. At the end of the 25th year from the date of investment, the scheme matures and the girl child will be entitled to the total deposit amount plus the interest accrued on the same. If in between there is requirement of money by the girl child, then she can withdraw the 50% of the amount after 18 years from the date of start of investment. And one more condition is there: the investment has to be the scheme matures at the end of 21 years or the date of marriage of the girl child, whichever is earlier. The interest rate currently offered in this under this scheme is 7.6%, and actually there are quarterly the interest rate keeps on changing under this Sukanya Samruddhi scheme. Next is payment-based deductions under Section 80C. This includes life insurance premium, children's school fees, and principal repayment in home loan payments. The life insurance premium is the premium paid for term life plan taken by the assessee as well as other life insurance plans which are available. For children's school fees, we need to note one thing, that the donation charged by the school is not available as deduction. Also, the bus fees paid by the parent is not available as deduction. The remaining term fee and any other fees charged by the school is allowed as deduction subject to maximum of 1,50,000. Principal repayment in home loan payments. Whenever assessee takes home loan for construction or purchase of house property, he has to pay interest as well as principal repayment is done by him. So in this case, the principal repayment portion is allowed as deduction under Section 80C. This has been brought in by the government to promote house purchase by the Indian population. Next is investment under Section 80CCD. This refers to National Pension Scheme. There is the pension plan introduced by the government. As a salaried employees have to can contribute to this national pension scheme as well as employers also contribute on behalf of employees in this national pension scheme. As we can see, the limit for employees contribution which is allowed as deduction as well as employers contribution which is allowed as deduction is 10% of the salary. However, there is an additional deduction allowed under Section 80 CCD for any assessee whether he is employed or not, and that is a maximum of 50,000 rupees is allowed as deduction. And this deduction under Section 80 CCD is over and above the amount of deduction available under Section 80C of 1,50,000. So if a person invests in both 80C as well as 80CCD, total deduction which he will be entitled will be 2 lakh rupees. Next, we come to Section 80D, which is available to individual as well as HUF, and this covers medical insurance and medical expenses for senior citizens. Under medical insurance premium, we need to note that the premium paid by a person for self and his family is allowed as deduction subject to a maximum of 25,000 rupees, and family includes spouse as well as children. If he pays insurance premium for his parents, then an additional benefit of 25,000 is allowed as deduction. And if the parents are senior citizens, then instead of 25,000, additional benefit of 50,000 is allowed as deduction. Suppose the associate has not taken insurance for the parents and they are senior citizens and is incurring medical expenses for the parents, then in this case still the deduction is allowed under Section 80D, and that is subject to a maximum limit of 50,000 for parents. So for example, if the assessee is paying medical insurance for himself up to 25,000 rupees and he is incurring medical expenses for his senior citizen parents up to 50,000 or more, up to 50,000 or more than 50,000, then a total deduction which will be available to the individual will be total 25,000 plus 50,000, that is 75,000 rupees. Next, 80TTA and 80TTB. 80TTA is in respect of interest earned on savings account deposit, and this is available to people who are other than resident senior citizens. For resident senior citizens, it is specifically not allowed. So this is basically on interest income which is earned in the savings account of the assessee. So the maximum limit of deduction is 10,000 rupees. So for example, if the interest earned in savings account is 5,000 rupees, then the entire 5,000 will be allowed as deduction under 80TTA. If the interest earned in saving account is 15,000 rupees, then maximum 10,000 will be allowed as deduction under section 80TTA. Next is 80TTB. It is available to resident senior citizens only, and the limit under this is 50,000 rupees. There is a specific difference under section 80 TTA and TTB. The first difference is TTA is not available to senior citizens, resident senior citizens. The second difference is under section 80 TTA. The individuals get deduction only in respect of interest earned on savings account. Interest earned in respect of fixed deposits, no deduction is allowed. However, under section 80 TTB, resident senior citizens are allowed deduction on any type of deposits, both fixed deposits or savings account deposit, subject to a maximum of 50,000 rupees. Next, section 80E. Many times, for the purpose of education, individuals take loan either for their own education or the education of their children or spouse. So, to promote this, the government has introduced section 80E. Under this, interest paid on the education loan taken from financial institutions is allowed as deduction without any limit. How much ever interest the person pays, the whole amount is allowed as a deduction under section 80E, and this deduction is allowed from first year up to a total of 8 years. So it is a very good initiative by the government, and the amount which is covered is loan interest on loan taken for higher education. Higher education is defined as any degree taken above after 10th standard SSC certificate. So under this, the individual can claim interest on loan, education loan claim for him taken for himself as well as taken for studies of the children. So these are the various sections which are there for the deductions from income for individuals and HUF.